The essence is a closely held C corporation owner. In this example, a woman founded the firm about 25 years ago, grew it to be a very, very successful firm, and had her daughter and her son as minority interest holders. As most C Corp owners, most all of her assets were tied up in that family business. So when any charity came to her to make a request for a contribution, she immediately thought about checkbook giving, which was by far the smallest piece of her overall balance sheet. And again, cash bad, everything else good, so she was not the most conducive way to make the gift. And instead, her planners designed a program where she could make a gift of her closely held C corporation stock to a community foundation. They would have that appraised to be able to take the full fair market value deduction appraisal for that gift. Then the company turned around, bought the stock back from the community foundation using retained earnings. In some cases, you could use a note to do that, but they simply used retained earnings to buy that stock back. She now has all of that stock out of her estate for estate tax purposes. No capital gains taxes at the time of sale when the company buys it back from the community foundation. And then, interestingly, the minority shareholders, her daughter and her son, her interest just went up with no transfer taxes at all, because when the company buys the stock back, they retire that into Treasury. And therefore, there are less shares outstanding, and the number of shares they have now represent a larger proportion of the company. This one specific example would be a limited partnership gift. In many cases, people will own real estate inside of a limited partnership, and a donor wanted to be able to make a gift of farm property in the Midwest, wanted to receive a full fair market value deduction for that. There was a buyer in the wings. As you know, most farmers, all they want to do is expand the footprint of their own farm. So an adjacent farm owner had come to this person, asked if they might have an interest in selling their property. They did, but they didn't want to pay the capital gains taxes. And the family wanted to become much more charitable across a multitude of different charitable interests that they had, and in fact with 2 or 3 different generations of family members being involved. So what we did was we helped the donor make the contribution of the limited partnership gift to the community foundation. The donor was able to receive a full fair market value deduction for that gift. The gift was sold to the adjacent farm owner, and then the fund then was created through the sales proceeds so that the 3 generations of the family members could get together once a year and to make gifts across both their region as well as across the United States as well. We helped a charity receive a seat on the New York Mercantile Exchange, and when we were originally approached with that gift, we had no idea whether that was a capital asset, whether that was an ordinary income asset. So simply we asked the donor to call the CPA, ask the CPA, if I were to sell this on Friday, what kind of tax will I have to pay? And the donor called back and they said it would be a capital gains tax, and that's all we needed to know. So it was held for the long term. We were able then to make that gift to a public charity that had a donor-advised fund. Donor got the full fair market value deduction. All the capital gains taxes were eliminated to the charity, and then the donor was able to use that as their mini, quote-unquote, family foundation for charitable giving purposes.